There are housing promises and then there are housing realities. And the gap between the two, well, it is ever expanding. Meanwhile, we've got rents that are dropping fast while new rental unit completions are hitting a record pace. Employment insurance claims, though, they're skyrocketing. But then check this out. New listings across the country just hit a 45-year high. But also, at the same time, we've got new mortgage originations. Well, they're up 90% year over year. What the hell is going on with Canadian real estate? Well, Ryan and I, we're Vancouver real estate advisors for the past 8 years and top 1% agents. We are going to dissect what is driving the divergence in the real estate markets across the country and see if we can make sense of some of the alarming numbers that we're seeing. Let's dive right in. Let's talk housing starts first, because how many times have you heard a politician touting housing initiatives and about hitting these lofty building targets over just the last couple of years? Quite a bit, right? Like there's that housing accelerator fund, for example. How's that working out? And, as recently as December the 20th, the BC government put out a news release touting the home flipping tax and how that was going to help make homes, well, more affordable. Again, nothing to do with supply, just demand side policies. And are they working? Well, let's look at the data. Housing starts on a 6-month trend, right? We're looking at housing starts because we need more housing. How many housing starts are taking place so we can get some supply, which will ultimately even the playing field and ideally bring some prices down. Anyway, housing starts on a 6-month trend peaked in 2021 at 285,000. Since then, they've dropped 19% to where we are today at 239,000. But let's be fair. There are a tremendous amount of rental homes coming. Rental unit starts are up 44% year over year in January and account for 45%, almost half of all the starts in the past year. Today, there are a record amount, 144 units in the pipeline for that rental segment. Compare that to end user condo starts, which are down like 31% year over year. In fact, if you take out that rental segment of the marketplace when it comes to housing starts are at the lowest level since 2009. While this is likely welcome news to renters for the rental segment of that number, of course, because already rental rates are falling and we've got that record number of units completing, rental rates look all but certain to continue their downward trend. And then now it's like, how is that going to affect the investor market, right? At least like that condo investor market, the mom and pop investors that have kind of been investing in these 1-2 bedroom condos for the last, 30 years. They've been all the rage because they've kind of just gone up and to the right for decades now, right? You just couldn't lose with those. Obviously, things and times are changing. That market is ultimately evaporating fast. And those that realize how many rental units are coming to the market in the coming years will be putting their dollars to better use elsewhere. Obviously, cash flow and the returns on these little mom and pop style condo investments, they're diminishing, right? And you can expect the condo market, especially in like the downtown cores of the bigger metros of Vancouver and Toronto, they're going to continue to struggle and potentially for years. I mean, think of it like this, the downtown Vancouver market for condos, you can buy a condo today at the same price you could in October of 2017. That's over 7 years of no appreciation for that asset class in that area. And with the predominant buyer in downtown being, of course, pretty much investors, right? They're over 60%. You're hard pressed to find signs that point to prices in that area and those areas of those property types going up anytime soon. The next few years, I think, are going to be ones of divergence because, listen to this. January of this year saw only 3,800 single-family homes completed. That is the single lowest of any month dating back to 1997, a 28-year low. It bears repeating. The single-family home is becoming a rare asset. If you have one, you might want to hold on to that.
Well, it's quite a picture you're painting there, Dan. I'll have to say, condos, I think I look back at sort of the last 30 years because you mentioned it, how back in the 90s, the mom and pop investment was to buy an investment property, a condo, if you will, and sell it later for your child so that they would have somewhere to go, maybe a down payment or something to that effect. And over those sort of 30, maybe even 40 years, you saw the average price appreciation somewhere between 5 and 600%, which is a tremendous run up. And the question I have is whether or not we're going to continue to see that same rate of appreciation for the next 30 years. Based on sort of what I just heard, it doesn't feel like it's going to be the same vehicle that got people where it did over the last 30 years as to where it's going to go in the next 30 years. And that is largely due to affordability. And much like you said, I think the one thing that will continue to go up will be the single family home. One, because it's rare, but two, because of its utility, and three, because of its redevelopment potential. So those are three real reasons why I think single family homes are probably a very good investment going forward. If, like you said, you can either hold on to it or get into one. They're extremely expensive. But let's dive a little bit deeper into this rental market, because the amount of non-PR growth is correlated with rent growth. Makes sense. The non-PR growth rate was dropping from 48% in the peak of 2023 down to 20% today. Rents have started to follow suit. So after 38 months of rental rate increases, the reprieve is here. And they have started dropping as of September of last year. And we've now seen 4 straight months of declines, lowering by about $100 a month, an 18-month low. Right? So national rents, they peaked in January 2024 at $2,196 on average. And we're now seeing that hit about $2,100 on average. Much like Dan said, and I fully agree, I will expect to see this number continue to drop going forward, especially when you consider the amount of new product that's coming to market that will take those premium rents. When you consider that, and you consider the volume of shared accommodations too, the listings have increased 42% year over year in January. That is also an all-time high. Shared accommodation rentals dropped by about 7.5% year over year, and that is an 18-month low. What's more is BC leads the country with the amount of rental units under construction, as a total share of the rental stock in the country sitting at 14%. This means there's a lot more for renters that are coming and a lot less for potential investors.
So the rental rates dropping will understandably affect inflation. And we just got the latest inflation print data out this week. So let's touch on it quickly here. It hit 1.9%, which was a slight increase from the month before, being December, that was at 1.8. But it does mark the 6th month in a row where inflation is at or below the 2% target. I mean, remember not so distant past when there was kind of talk about 3% being the new 2%, which could still happen, of course. But as of today, 2% looks to be quite achievable, or at least it has been for a full half year now. Of that 1.9% total inflation, the vast majority, 1.3%, was from the shelter component. So as we move forward here, we are going to see base effects come into full effect, because noted mostly is the mortgage interest costs. Those have been dropping steadily since around the same time as the rate cuts began, lowering from 30% down to 10%. And last month, mortgage interest costs rose, but only 0.2%. Okay, that's the weakest monthly increase we've seen going back almost 3 years to April of 2022. If we remove mortgage interest, just that element of the shelter basket, from the entire CPI basket, we've been flat for about 2 years now at only 1.3%. So while that sort of frame up may lead the Bank of Canada to want to cut rates again next month, there are understandably other factors at play. The money supply, for one, is actually expanding again, at least when we measure it by the M2++ factor, which, what the hell is that? Well, it is a broad, I'll read this verbatim. M2++ is a broad measure of Canada's money supply, which includes cash, checkable deposits, savings bonds, and mutual funds. So that element of money supply jumped 2.7% in just the last 3 months alone, which for reference is the largest increase we've seen since mid 2021. And what was happening back then? The money printers were flying and we had helicopter money and all sorts of stimulus was coming because of the COVID lockdowns. Now, why does it matter? Why do we track this metric? Well, the more money in the system, the more spending that seems to happen, right? We just mentioned COVID and we all know how much spending happened then and the resulting inflation that ensued. The M2++ is a key indicator of inflation, right? When we track that type of money supply, we also see inflation affected. So the Bank of Canada may need stable or even increasing rates to offset money printing measures. It's just kind of a potential crystal ball that we're looking into here as to what might happen again should the money supply continue to increase, especially at the rate it did over COVID.
And I think that'll be further exacerbated by a weaker loonie as we try and import from other parts of the world with a much weaker loonie. It's going to require more dollars for the same products. So what's more with this weak Canadian dollar is it's already showing an impact in raw material prices. So the index for that rose 3.7% in January and is up 11.2% year over year, the highest rate of increase in 2.5 years. This increase in material costs are passed on to consumers. We're already seeing the industrial produce price index up 6% year over year, which is a leading indicator that inflation is going to follow. About 10 to 12 months is sort of your indicator there. And so what does this mean for the BOC rate announcement next month? Well, markets are pricing in less than a 30% chance of a cut in March and only 2 more cuts for the remainder of 2025. But that is, of course, if no tariffs come into play. If they do, it changes the entire landscape. Just for reference, 2 more cuts would bring us to 2.5%. But in the event that tariffs actually take place, you could see a potential structural change in the overall economy. And I don't think it's going to get a lot better just with interest rates. I think there's a much bigger problem for the Bank of Canada if those tariffs become sweeping and wide set. It becomes very problematic for Canada, and it could totally change the course that we're on right now. What's more, let's look at jobs too. Jobs are very important. The EI claims are telling a story about how Canada is actually doing. When we look nationally, EI claims are up from 245,000 at the beginning of 2023 to over 280,000 as of December. It's a 14% increase. And what's much worse than that is the most populous province, Ontario, has seen claims rise from 76,000 to 98,000 over that same time frame. That's a 29% increase in what is Canada's most populous, largest employing province. A strong indicator of future GDP dropping at a noticeable pace. The overall country feels as though it's grinding down to a halt. It's kind of scary.
Yeah. Interesting to see Ontario and of course Toronto almost be the epicenter of the housing market right now. I mean, it's experiencing the most extreme pendulum swing to the downside, especially obviously in that condo market. And now they might be the forerunner in the jobs decline as well. And it's already starting to show up in the data. And you could just imagine how tough that province will have it should actual tariffs come to be. So we will continue to track that for you. Now, an interesting shift here. I want to talk to you about mortgages and mortgage originations, right? So what isn't a mortgage origination? Well, that covers the new loans, refinances, and renewals. Those surged 90% year over year in December. And let's be honest here, like this is likely consisting primarily of renewals, right? Because we are sort of right at that beginning, a few months into that 5-year renewal period for mortgages that are renewing from people who either renewed or got their mortgage when rates were near zero. And as rates were back in essentially the ones back then, and now they're in the fours, well, anybody renewing today is facing about a 35% payment increase shock today. So we're going to obviously track careers and track sales and track foreclosures. But as of right now, there is a lot of movement in the mortgage industry. And I'll be honest here, like some of our closest brokers are talking that they're as busy as they've ever been, and not just in the renewal side and not in the refi side, but in brand new mortgages. So just this interesting dichotomy across the landscape here of what is happening and who's doing well and which segments are suffering. And it's all a bit confusing, to be honest, because we're getting polarizing data every single week.
Let's be honest, just because people actually get a mortgage approval doesn't necessarily mean they're going to buy either. So, take it with a grain of salt. People might be seeing what kind of rate they can get. What can they shop if prices are coming down? So a lot of potential preparation taking place. Whether or not they'll exercise it remains to be seen, but it's nonetheless a healthier metric to point us in maybe a bit better of a direction than what we're currently experiencing. Dan, I'm also thinking with this renewal, where payments are going to go up by 35%, what is that going to do to the overall, complications that we're seeing now with the threat of tariffs? I mean, it's all fine and dandy if the economy is robust and people are still being paid and people have opportunity to make more money. But if that goes away, this 35% increase in rates could be very problematic, especially if employment numbers continue to, or unemployment numbers continue to rise. It could be a very interesting sort of mix that we find ourselves in, one that'll probably be difficult for a lot of people. Let's have a look here and shift gears just a little bit. We'll have a look at retail sales because, again, this is also bucking the trend in a kind of bizarre way. It's contrarian to what we're seeing in the rest of the economy. Retail sales in British Columbia were actually up 1.6% in December, month over month, and up 2% compared to the same time last year. Retail sales levels are oddly at a record high. So people don't typically go out shopping when they're feeling financially strapped. So then is it just BC that has a lot of money sloshing around, or have people pulled back on large expenses like we saw during COVID, where they're not buying cars, they're not buying watches and things like that, but rather they're still buying a PlayStation for their kid, or, they have to buy clothes because they're growing, that kind of thing. There's some leftover money that's still clearly in the retail system. So we'll see how it pans out. It may just be a blip, but we'll keep an eye on it.
Yeah, maybe it's not the family trip this year, but it is a couple extra gifts at birthdays or whatnot. But yeah, very, again, interesting shift. And what else is very interesting is the inventory story. And it's framing up like almost no other year before, because the full data is out now for the month of January when it comes to our national real estate data. And new listings surged 11% across the country month over month. CREA, the Canadian Real Estate Association, noted that this was the largest seasonally adjusted monthly increase in new supply on record going back to the late 80s. That's that 45-year jump I just talked about. A 45-year record is an incredible number and very unusual for the month of January. BC saw the largest jump at 29% month over month, and easily the most in over 15 years. So we contributed quite heavily to that metric. And BC and Ontario have the highest level of resale supply right now, active inventory, in 10 years, in a decade. And interestingly, if we look at the pre-sale inventory across the greater Vancouver area as well, that historically, it hovered right around the 7,000-ish number from 2019 all the way to 2023. But since the market slowdown, it has skyrocketed up to 12,000. Okay, over a 50% spike there, and that's kind of where it is today. And if you were to add that resale inventory and put the pre-sale inventory on it, today we have about 25,000 homes across the Lower Mainland to choose from. That is just not an environment where you're going to see prices increase. And this is definitely being reflected in our mini market update here, right? We'll get the full data by the end of February, but I wanted to give everybody a mini market update because it's very telling as to what's happening on the ground in real time. We are on track to see about 1,830 units sell total in the month of February. That is a 12% drop year over year. And this is a dramatic change. And here's why. If we go back to October of last year and go all the way up to January of this year, every month was year over year a higher number of sales. But to drop in February and to drop double digits is very notable. And it might be a significant insight into the shift that's happening in our marketplace. I mean, we sell real estate every single week. We talk to realtors and clients every single day. And some of the agents that we know that do significant volume, they are all talking about the slowdown that they're feeling. And it's all coinciding literally with Trump's inauguration and all this tariff talk, right? We talked earlier about how COVID really put people on the sidelines in a wait and see and a holy crap, what's going on? We don't know. Let's just wait and hash this out. A little bit of that same feeling still here today, right? People don't know what's going to happen with tariffs or Trump on a minute by minute basis here. And that's kind of really shocked the system into a freeze. And prices are dropping too, right? A lot of the metrics we spoke about earlier, maybe it's no surprise as to why prices might be dropping. Median is down another 20K. We're sitting at 900,000 right now. And for reference, that's a 10% drop from the peak, and it's also a 16-month low. Average is down around 20 as well right now, and that's at a 2-year low, but also 10% below that all-time high peak. So it kind of feels today like it's going to take a bit of time for the market to maybe absorb and be okay with the Trump volatility levels, right? There's going to be a point where that just kind of becomes the norm, and I think with natural human resilience, people might come back and say, okay, well, life goes on. It's still okay for me to buy a home or sell a home or rent a home or whatever they want to do, right? But right now, the system is shocked. We've got to figure out what's going to happen with all this employment and unemployment and mortgage renewals. And ultimately, the way it's all kind of framing up, it seems like 2025 is going to be a sluggish grind with prices sort of trickling down for at least the foreseeable future. Ryan, is that kind of what you're feeling too?
Largely, yeah. And if we get the widespread tariffs that we're talking about here, I think you'll see further price declines than what we're currently seeing right now too. And what I mean by that is you got to think, if your cost of production is going up and the cost for Canadian goods is going up, then the demand for those goods south of the border is going to go down. The reciprocal effect of that is layoffs from companies who want to survive. So they'll cut their workforce, unemployment will rise, more GDP will slow, and that will find its way into the housing sector. And you could see, with less and less demand, you could see prices continue to soften. And so, we've jokingly said many times on the podcast that, prices in Vancouver typically swing down about 15%, and then people start jumping in. And like you mentioned before, prices are about 10% down from their 16-month low. So I'm wondering, are we going to find price support with another 5% as we continue to go down? And I think that entirely hangs on what takes place with Trump's tariffs.
There you have it. That is what we have for you this week. Have a wonderful weekend, and we hope to see you here next week.